Hello, welcome to the week ahead in charts. It is week 46, the 14th of November. My name is James Kim, one of the sales traders here in Asia Pac, recording live from Sydney, Australia. This week we will be running through some very strong levels coming up for the US dollar index. We also have some firm buy levels over the euro. We'll also examine levels over the cable, Aussie dollar, dollar yen in terms of indices. We've got some strong sell levels coming over Nikkei Futures. We'll examine some price actions over the US 30, US 500 as well as the Aussie 200 index CFD. In terms of commodities, we'll look at the traditional WTI crude, copper and gold, and we'll cap off the presentation with two ETFs, the Dow Transports ETF, IYT, followed by VWO, the Emerging Market Equities ETF. The US dollar index was strongly supported along the lower channel trend line in the past week, and as we had highlighted in last week's presentation, this was the level to hold further losses. We also highlighted the 200 daily moving average, which sits just below the lower trend line, and the US dollar respected this level as well. Now, we also presented this weekly chart last week, highlighting the intersection of the upper and the lower pennant trend lines. So in respect to timing, the low printed over the US dollar index does not get better than what we saw last week. Now this week, as the US dollar index hovers around just above the 99 handle, it will need to maintain its price actions above the October's highs. And in addition to our fresh high, which is what we're seeing here in Asia, we need to start seeing momentum pick up. As what we are currently seeing right now is a bit of a diverging sort of setup. Whilst the US dollar index sits at its highs, momentum is displaying a divergence, as you can see, which sort of gives you a confirmation that the steam may be running out in this rally. To the top side, the 100 handle may act as a major resistance, and coincidentally this week, the upper channel trend line, which has defined the US dollar moves for the best part of 7 months since April, offers potential rejection as we saw in July and in August of this year. We entered last week stating that the euro continued to remain upside corrective, also providing levels to fade continued rallies. Our level of the 200 daily moving average failed to hold initially, instead rallying a further 120 pips or so above here. But for those that had the US dollar chart marked up as we had presented last week, whilst the euro was hitting up against its head on the 200 DMA, the US dollar was nowhere near that support level that we've been monitoring. So I guess that was the giveaway that the euro had slightly more room to rally. The high over the euro was also called by applying a 100% extension of the range between the June low up to the August high. So this was pretty much the levels. Here we go. So that was the repeating range that had to occur, and that range pretty much called the top of the euro last week. Now I must highlight that whilst the euro makes new lows here in Asia, momentum on the other hand is showing you a bit of divergence. Now this is what we call an A-class divergence, where whilst the instrument makes new lows or highs, as is the case with the US dollar index, the momentum holds strong, and the current pattern suggests that the decline over the euro may mature within days, if not already. So this week, not only do we have attractive short opportunities over the US dollar index at the 100 level or just below, the euro itself also presents some unique long opportunities, especially if the euro continues to maintain its momentum. Now, below last week's low here in Asia, it has printed a very significant price level. If we look at the retracement between the low in 2015 here up to this year's high, it pretty much traded slightly below the 76.4% retracement level and is now bouncing off that level as we speak. We also can see that there is a repeat in price action in range. If I apply the recent range between the top in August down to the low in October and apply that top of that the top, sorry, if we apply that range to the top, we also see 100% repeat in price at just below the 108 handle. So we like this level over the euro right now. We do feel that these are some long opportunities here, with stops to be placed below the 107 handle or below the 2016 lows, which was seen in January. Now our base case for the cable remains unchanged. We call for higher moves with any pullbacks to see support at the short-term trend line here, and we aim for a print of 128.42 to the top side, which, as we outlined last week, is a 38.2% retracement between the pre-Brexit high to the recent October lows, and we expect gains to struggle at this level given that it happened to be the support for cable throughout July and then in August of this year. The Aussie dollar this week is in serious trouble as the weekly close happened to come in below the lower channel trend line, which has supported the sell down in Aussie throughout this year. Now the Aussie has also produced an outside weekly bar with the close at its lows, now which signals also that a reversal signal is on our hands. If we go over to the daily chart, you can see that today here in Asia it was supported at the 200 daily moving average, but I must highlight that the 200 daily moving average has not provided any strong support or very strong resistance level in the past, except one instance here in February, so we're not expecting too much here. Now any rallies that we see from here on after, we do expect rallies to terminate at the lower channel trend line. Now we also need to see a second consecutive close below this trend line in order for the break that we saw on Friday to constitute a true break. Otherwise, if the Aussie settles back within the channel, then last Friday's close will prove to be a false break for now. So on the back of a second settlement below the lower trend line, again any rallies will most likely struggle as it trades back above this trend line, and should we see that confirmation of a couple of rejections here, then that would be the signal that a deeper sell down just may be on its way. Now another thing to point out on the Aussie is the failure for the Aussie to hold its gains last week was commodities continue to rally, and we saw copper hit its biggest gains in 7 years, iron ore rocketed 23%, and really truly was risk on mode, and this sentiment, which could not hold up our domestic currency, is being translated by the market for further losses to potentially lie ahead. Our final support level over the dollar yen at precisely 101.30, as we mentioned in last week's video, held the dollar yen's violent losses. The daily close of the dollar yen at its 200 DMA is an encouraging signal that further gains lie ahead. Now on the weekly chart, the dollar yen is still nowhere in overbought territory, so there is more room to the top side, and we do target the 200 weekly moving average at 101.30. However, at the moment it is currently trading at the July highs here, so it may struggle potentially at this level, with any pullbacks to be supported at 105.51 this week. And just as the Nikkei was being carried out in stretches, if we look at the weekly chart, strong support was offered at the 200 weekly moving average last week. Back to the daily chart, the Nikkei is expected to follow dollar yen's direction and not far above from where it is currently trading right now. Faces hurdle starting at April's highs here at 17,820, followed by 17,934, which for now is the 2016 high seen in January. Once the Nikkei clears these levels, level 1 and level 2, then all eyes will be on the 18,000 handle, and the 18,000 handle happens to coincide with a 18,000 handle sits just above the 50% retracement level between the all-time high down to the recent lows. Now this is a very significant retracement. If I look at the weekly chart, the 50% retracement just below the 18,000 handle happens to coincide with that high in January. So we do look for a very heavy resistance at these levels upon a higher move, and this should be a level that should be on our radars each and every day for those that are currently long the Nikkei Futures. Now the Dow successfully printed fresh highs last week with 19,000. Next up as the level to claim on higher moves. The S&P 500 on the other hand is yet to break out to new highs, still struggling below this year's peak. Prices are also failing below the January to June trend line it recently broke, and this trend line has ever since acted as a resistance over the S&P. So the test this week would be to settle above here and for the index to make a new high as well. The 61.8% retracement between the February low to the 2016 highs called the low over the ASX 200 last week, with the index also being supported at the June swing low here. Now after breaking the April, June, September support trendline, the ASX index is now trading back above here, with support to be continued to be offered at this trend line with a break below again to see next support at the 200 DMA. Now this week our Aussie 200 index approaches heavy resistance as offered by the July, August, October trend line, and we look for the market to fail here. Only an unexpected break above this level would introduce scope for our index to then test 5500 or the October highs, followed by 5570, the August highs. So only a break above this trend line would be necessary to argue for a longer term bullish shift. The 200 daily moving average over crude only lent temporary support last week, and crude unfortunately closed below here for the week, and here in Asia currently struggles just below that 200 daily moving average. Crude hovers just above the August to September downtrend line that it managed to break, and at the same time it trades near the September swing lows, which is one level we have marked for several weeks now as a level to watch for support. Now a break below this trend line here and below September swing low opens up August lows at 39.19, which is the level that needs to hold crude losses. Otherwise it will experience a potentially larger and a deeper sell down. The market will not be expecting too much from crude this week. A settlement above the 200 daily moving average for the week will be good enough, and a signal that losses may just be turning. And what a week for copper. Not only did it manage to smash through that 2011 downtrend, it put in its best performance in 7 years. Whilst copper was rejected off its highs, we see another rally coming and see the 200 weekly moving average to potentially capture recent rally over crude and then over copper, and then for copper to enter into a consolidation phase. To the downside, we mark support starting at 236.56 down to the 2011 trend line. It broke above last week. Gold was left brutally bruised and beaten up into the close last week. However, now fast approaches some strong support levels. An initial rally last week was met with a rejection slightly below or above the June, July, August downtrend, and the break of the short-term September-October uptrend was enough for stops to trigger and for an aggressive sell down to follow. Now, if we shift our focus to the momentum, RSI fails to make new lows whilst gold itself makes new lows. So a very similar setup to what we're seeing over the euro. We have another set of an A-class divergence over gold. Now this week we mark support at 12.10 as the first level over gold to be watched, followed by 11.99. So a break below 1200 is not going to be a significant event for us, especially should the RSI continue to hold up. Now the 1210 level we mark as first support will be an interesting level to watch for a hold, given that it is a 50% retracement between this year's lows to this year's peak. A quick revisit of the ETF over the Dow Transports, ticker IYT, which we first highlighted on this presentation precisely 3 months ago in August. Now the ETF is now close to or pretty much at its 76.4% retracement between the 2014 high to this year's low, which was our target. This also coincides with a 38.2% inverse head and shoulder breakout level. Now a trade above here, we'll see the ETF travel as high as 159, which would be a 50% extension level of the range between the head to the neckline applied to the breakout level. Talking about inverse head and shoulders, following is a chart of the emerging market ETF, ticker VWO. Since Q3 of last year, this ETF has consolidated perfectly in an inverse head and shoulder formation, with a breakout being seen in Q3 of this year, with the recent high coming in at the 38.2% extension of the head to the shoulder range. Now, with the sell down last week over this ETF and other emerging market themes, this ETF has received some strong buying interest along the neckline here, which is a classical support level. So for now, unless this ETF settles below the neckline, we have some unique buying opportunities over this emerging market ETF, with stops to be placed below the neckline. That pretty much wraps up our presentation for the week ahead in charts. I'm wishing everyone a profitable and a fruitful trading week ahead. Thank you.